Jack, thank you, ladies and gentlemen. It's a great pleasure to be here in Frankfurt. On the panel, in a few minutes' time, we're going to be asked to talk about monetary transmission gaining traction. We're asked to consider how the monetary stimulus actually affects the real economy, whether it be through insurance companies or banks. But as background to that panel debate, I'd like to just deliberately provoke by suggesting two caveats, stressing first how imperfect are the transmission mechanisms of pure monetary policy, and second, the importance, therefore, if we are to rely on monetary policy alone rather than fiscal stimulus, of finding creative ways to ensure that its transmission mechanism into the real economy is effective, rather than simply into the very lovely value of the DAX or the very rapidly declining value of the euro. Now, the essence of my argument is that monetary policy alone can be pretty ineffective in the face of one word, which is debt, large accumulated debt. The 2008 crisis was a huge crisis of the financial system itself. And for people like me who lived through that crisis as a regulator, and I became chairman of the FSA, the UK FSA, on the 20th of September 2008, 5 days after Lehman Brothers had collapsed, and so I'm unlikely ever to forget what the subsequent few months were like. I've often said it was rather like being appointed captain of the Titanic after you've hit the iceberg, but before you've actually sunk. We're never going to forget that. But what I think will be really striking in economic history is maybe not autumn 2008 itself and the crisis, because we've had crisis before, nor indeed the scale of the bank bailouts by public money, because actually, in retrospect, they're pretty small. They're 2 or 3% of GDP. What is going to be striking to economic historians is how slow and weak was the post-crisis recovery, and how extraordinarily poor we all were at forecasting that weakness. In early 2009, when we'd got through the crisis itself, almost no one in the central bank community, the finance market community, the finance ministry community, the economists, or the market commentators, nobody anticipated that, as Uwe Stegemann said earlier, GDP now would be 15% below its pre-crisis trend in Europe, and even 10% below in the US. Nobody thought that GDP per capita in all the advanced economies would not yet have returned to its 2007 level, almost a decade of no growth in prosperity. And no one in central banking, in the IMF, in the financial markets, thought it at all possible that interest rates 6 years after spring 2009 would still be at zero, in some countries negative, and in some countries, I suspect Japan and the Eurozone, for instance, likely to stay at zero for several years to come. And the fundamental reason, I think, for those unanticipated developments was the increase in debt, and in particular private sector debt, not just over the decade before 2007-8, but over the previous half century. In 1950, private sector debt, so that's household and corporate debt, I'm not talking about public debt, private sector debt across the advanced economies on average was 50% of GDP. By 2007, it had got to 170% of GDP. And before the crisis, it's fair to say that most central banks, most economists, paid little attention to this growth in private debt. There was quite a lot of focus on public debt, about Greece's debt being too high or Italy's debt being too high, but there wasn't much focus in Europe about Spain or Ireland's private debt or the US private debt growing at an extraordinary level. The belief was that as long as central banks achieved low and stable inflation, we could assume that whatever the level of private debt was, it must be sustainable and efficient because it had been produced by an efficient and rational private market. And indeed, that probably might have been the case if all credit in our economies was extended for the purposes that our economic textbooks describe. If you pick up an undergraduate economic textbooks and read the section on banks What it says is banks take deposits from households and lend it to businesses, thus allocating capital between alternative capital investment projects. Unfortunately, as a description of what banks or indeed capital markets do, debt capital markets do in the modern world, that is almost entirely mythological. In advanced economies, most bank lending, 80% or so, and in the US, a similar proportion of all capital markets lending, does not fund new business capital investment, but funds either increases in consumption or the purchase of real estate. And although that sometimes means new real estate investment, it primarily means that it funds a competition between different people for the ownership of real estate, whether residential or commercial, that already exists. And there's a wonderful paper by Oscar Jorda, Morris Schullerich, and Alan Taylor, which documents the way that the banking system, and in the US, the debt capital market system, back in the mid-20th century, about 30–35% of what it did was real estate, and that now that is 65 or 70% or higher. And that has very major implications, because when credit is extended against real estate, there is a very strong tendency for self-reinforcing cycles on the way up, where more credit produces more asset prices, produces more credit, and for cycles on the way down. And there's danger that in the upcycle, we create levels of debt which are objectively unsustainable, and which then mean that borrowers in the downswing focus on reducing debt, thus imposing a huge deflationary impact on the economy. And fundamental to financial and economic stability is, I think, the increase in debt which occurred before 2007-8. But before the crisis, we paid little attention to it. I think we should have done, because we had an example. We had, as it were, a canary in the mine, which should have warned us about what was coming, which we should have known about in 2009, and that canary in the mine was Japan. Japan in the 1980s had the biggest credit and asset price cycle that the world has ever seen, increases in private credit of about 4 times during the course of the 1980s, increases of Tokyo real estate prices of about 4 times. In 1990, the bubble burst and the prices came down, and a whole load of companies, and in the Tokyo case, in the Japanese case, it was primarily companies and commercial real estate rather than residential real estate, a whole load of companies became determined to pay down their debt. And they became determined to do that even when the Bank of Japan, in the course of the 1990s, cut interest rates effectively to 0. They entered what Richard Koo, in a very fine book, calls a balance sheet recession, where monetary policy was completely and utterly ineffective. That, of course, drove the economy into a recession, with falling tax revenues, increasing public expenditures on things like social security. That produced large fiscal deficits, which were both naturally arising and rather useful, because they provided the demand offset to private sector deleveraging. But with the inevitable consequence that as over the last 25 years the Japanese corporate sector has very slowly deleveraged, the Japanese public sector has leveraged up and up and up and up, from 50% public debt to GDP in 1990 to about 250% today. So what happened in Japan is that once we'd created excessive amounts of private debt, in the post-crisis recession, the debt didn't go away, it just shifted around the economy. Private deleveraging was offset by public up-leveraging. And that is precisely what has occurred across the advanced economies since 2008. If I showed you a chart for Spain, for the UK, for the US, for Ireland, what you would see is the beginnings of a very small element of private sector deleveraging, but for each percentage point reduction in private debt to GDP, there has been a more than offsetting increase in public debt, and combined leverage, private and public debt, has simply gone up. In some countries, the pace of increase has slowed, but that's been offset by other countries. All the countries that didn't go through a crisis, such as Canada and Sweden, have had very significant increases in leverage post-2008. Overall, for all the advanced economies together, as has been set out both by the Geneva report that came out in about November and by the latest McKinsey report called Leveraging and, open brackets, not much deleveraging. The Geneva report was called Deleveraging, what deleveraging? They both make the point, and they both provide the figures, that the total amount of debt and debt to GDP in the advanced economies has gone up. And as for the emerging markets, for the Turkeys, the Indonesias, and above all for the Chinas, there's been an enormous increase in debt, with Chinese leverage going from 150% to 250% of GDP in just 5 years. Overall, the world picture is that total debt, public and private combined, has not only gone up, but gone up at an accelerating pace. And that appears to put us in a situation where all our traditional policy levers for getting economies going again get blocked. Fiscal policy is undoubtedly in its short-term stimulative. I know that that's not a very popular thing to say in Germany, but if you want to understand why the US economy has grown faster than even the German economy, let alone the Eurozone economy, over the last 5 years, it has a lot to do with the fact that the US has had an average public deficit over that period of 6% of GDP, and the Eurozone has had an average public deficit of 1.6% of GDP. There is no doubt that the short-term impact of fiscal deficits is stimulative. But of course, there is the legitimate point, and this is where I would agree with the German point of view, that leaves the question, but what do we do about the accumulated debts? Don't we at some stage need to deal with that? And so we have fiscal consolidation, we have austerity, but then we enter an environment where we're trying to deleverage the public sector at the same time that we've still got a private sector deleveraging, and that really does drive us into a deep deflationary position. So our consensus to which we've navigated is that we need tight fiscal policies, at least after the initial 2009 stimulus, offset by ultra-loose monetary policy, which is the topic of our panel. But I think there are major issues about how effective ultra-loose monetary policy is and whether it has adverse side effects. We begin with ultra-loose monetary policy by taking the interest rate, the policy interest rate, effectively to zero, and then hopefully having a low lending cost into the real economy. But what Japan tells us in the early 1990s, from the mid-1990s on, is that if you've got a whole load of Japanese companies who feel over-leveraged, you can cut the interest rate to zero and they will still not want to borrow. And that is true of Irish homeowners and Irish commercial real estate lenders and Spanish commercial real estate lenders and homeowners after 2008 as well. Eurozone policy from about the 2011 onwards was very clearly predicated on the idea that if we only fixed the impairment of the banking system and got rid of the doom loop between sovereign solvency concerns and bank solvency concerns, that we would unblock the monetary policy transmission mechanism, and that then low policy interest rates set by the ECB would reach the real economy. That was what Mario Draghi said in many, many speeches. Well, we did AQR, we did the stress tests, and over a period of time, the bond yields came down, the lending costs came down, and the demand for credit did not go up. And the big test of this was the LTROs in September last year, where the ECB offered 400 billion euros at a price to the banking system of 10 basis points, 0.1%, and the banking system only took up 80 billion of that 400 billion. I think we were staring in the face of the fact that we face primarily a problem of demand for credit from companies and households which are already over-leveraged, rather than supply of credit. So that while fixing the banking system was absolutely essential, it is not sufficient to get the economy going again. So then you move on from ultra-low interest rates to quantitative easing, driving down the bond yields, hopefully then reducing not merely the short-term interest rate, but the long-term interest rate, and therefore making it easy to do long-term investment. But think about the transmission mechanism of that. When long-term bond yields have already come down over the last 5 years, 7 years, from 4 or 5% to 50 basis points, what possible difference can it make to real economy decisions if you then drive the bond yield down a further 25 basis points from 50 to 25? It's not a very powerful transmission mechanism. So we say instead it works via asset prices, and my God, it's certainly affected asset prices. I think in terms of the success of quantitative easing of getting through to equity prices, the 25% increase in the DAX since January the 1st is very clear. But the transmission mechanism beyond equity prices, through wealth effects, through companies feeling that their equity price has gone up relative to the new cost of capital equipment, what's called Tobin's Q, those are indirect transmission mechanisms, and we really don't know whether they're very powerful. So we come back to the currency market, and again, the first round impact of European QE has been effective with a very significant fall of the euro, and that will have some impact on exports. But I simply want to stress the point that you can't all do that simultaneously across the world. We can't all have lower currencies. Devaluation works very effectively for over-leveraged economies which are relatively small and where they've got into a problem and the rest of the world hasn't. So if you want to understand how Sweden and Finland pulled out of their over-leveraging crisis in the mid-1990s, devaluations worked very well because they were operating in economies where exports were 30 or 40% of GDP and where the rest of the economy was growing at a robust level. It is completely different when you're operating in an economy like the Eurozone, where in total, we're not talking about, 15% or so of GDP, which is exported. And that's particularly a problem if the rest of the world wants to follow the same strategy. I was in Japan and the Far East last week. You talk to the Japanese, they think one of the main transmission mechanisms of their QE is a lower yen. You talk to the Koreans, they now want to bring down their interest rates to bring down the value of the won. You talk to the Chinese, they're worrying about the slowdown of the economy and beginning to worry about the strength of the RMB. They might want to bring that down. There is simply a limit to which we can all achieve a stimulus through the currency rate effect. And there is a danger that the counterparts, and there must be a counterparts, for everybody running a trade surplus there must be a deficit, that they in themselves will either limit the growth stimulus effect or produce dangers. Dangers in, for instance, the very large increases in current accounts that we're seeing now in countries like Brazil or Turkey or Indonesia or South Africa, some of the fragile emerging economies, and dangers that in the US we are simply going to see such an appreciation of the US currency that it will limit their growth and therefore limit their growth of demand for the Eurozone surpluses. So I think there has to be major concerns about how exactly QE is going to get through to the real economy. It has clearly done the first step from ECB QE to equity prices and the currency. But the big issue is the transmission mechanism of either of those two through to the real economy. I think that we need to find more direct mechanisms of stimulus, and stimulus which works through domestic demand in the Eurozone. And by the way, remember, domestic demand in the Eurozone, nominal domestic demand in the Eurozone is 10% below, 9% below to be precise, where it was in 2008. We've already had a big shift at the Eurozone overall towards net exports rather than domestic demand. Mario Draghi at Jackson Hole last year said monetary policy can't do it all, that there may have to be some relaxation of those countries that can afford it, of fiscal austerity. With money alone, there are major issues about how effective it is going to be. So that is why I think the panel issue is absolutely right. How do we make sure that this QE stimulus does actually gain traction and reaches the real economy? One of the ways that it might, I think, and I end now, is through a small subset of the QE program which was announced. When the QE program was announced, it said that 12% of it, only 12%, would take the form of buying EIB bonds, and that EIB would then lend more money to infrastructure in Europe. That is a transmission mechanism that one can understand. It has some directness. It may have an impact. But I think what we need to debate is, are there other mechanisms as well? Because I am worried that without those other mechanisms to make sure that QE gets traction, we will have, yes, a higher DAX, and yes, a lower euro, but not necessarily a very much more rapidly growing Eurozone economy. Thank you very much.